At 2:47 a.m. Eastern Time, while most of America was asleep, silver crossed $70 an ounce for the first time in human history. Not the inflation-adjusted record, the actual record, the number that was supposed to be impossible. The number that 3 weeks ago, every analyst on Wall Street said we would never see in our lifetimes. They were wrong. And here's the part that should terrify you. This is not a spike. This is not a flash crash in reverse. This is not some algorithm gone haywire in the overnight session. This is confirmed. The price has held above $70 for 9 consecutive hours. As I record this, we are sitting at 71.63. The buy orders are not slowing down. The selling pressure has completely evaporated. Something fundamental has broken. I have been covering precious metals for 11 years. I have seen bull runs. I have seen short squeezes. I have seen manipulation and intervention and everything in between. I have never seen anything like this. What I'm about to share with you over the next hour is the result of 48 sleepless hours of investigation. Phone calls to sources I have cultivated for over a decade. Documents that were sent to me anonymously at 4 a.m. this morning. And one conversation, just one, that made me realize the $70 print is not the story. The $70 print is the distraction. The real story is what happens in the next 72 hours. And if my sources are correct, what happens next will reshape the global financial system in ways that the average person cannot comprehend. But you are not the average person. You are here. You are listening. And by the end of this, you will understand exactly what is coming. Let me start with what triggered the break. 43 hours ago, a name most Americans have never heard made a quiet announcement in Geneva. The Bank for International Settlements, the BIS. If the Federal Reserve is the head of the American financial system, the BIS is the brain of the global one. Every central bank in the world answers to Basel. Every major monetary policy decision flows through their coordination channels. They do not make public statements. They do not hold press conferences. They operate in shadows so deep that most financial journalists have never spoken to a BIS official on the record. 43 hours ago, they broke that silence. The announcement was buried in a technical document about reserve asset classifications. 17 pages of dense regulatory language that nobody outside of central banking circles would ever read. But on page 11, paragraph 4, there was a single sentence that changed everything. I am going to read it to you exactly as it appeared. Effective immediately, physical silver holdings meeting delivery specifications shall be reclassified from Tier 3 to Tier 1 reserve assets for participating member institutions. If you do not understand what that means, let me translate. For decades, the BIS has classified assets into tiers based on their safety and liquidity. Tier 1 is the safest category. It includes cash, government bonds, and, since 2019, physical gold. Tier 3 is where they put speculative assets. Commodities that central banks can hold but receive no credit for. Assets that do not count toward their reserve requirements. Silver has been Tier 3 since the classification system was created, until 43 hours ago. With a single sentence, the BIS just told every central bank on Earth that silver is now equivalent to gold, that they can hold it as a foundational reserve asset, that it counts toward their capital requirements at full value. This is confirmed. The document is public. You can verify it yourself. But here is the part that nobody is talking about. The announcement was dated 3 weeks ago. Someone knew this was coming. Look at the trading data from the past month. This is where the mystery begins. Starting on December 2nd, an unknown entity began accumulating silver futures contracts on the COMEX, not small positions. We are talking about blocks of 5,000 contracts at a time, 25 million ounces per trade. The open interest data shows it clearly. Someone was building a position larger than anything we have seen since the Hunt brothers in 1980. But unlike the Hunts, this buyer was not stupid. They did not announce themselves. They did not give interviews. They spread their purchases across multiple clearing members to avoid triggering position limit alerts. By December 15th, they controlled an estimated 400 million ounces of paper silver. 400 million ounces. Global annual mine supply is 830 million. One entity, in 2 weeks, quietly accumulated a position equivalent to half the world's yearly production. This is confirmed through CFTC data. The numbers do not lie, but here is what we do not know. Who is this buyer? The clearing data is anonymized. The position is held through a maze of offshore entities that trace back to jurisdictions with zero transparency requirements. Cayman Islands, British Virgin Islands, Luxembourg special purpose vehicles. I have a theory, and it terrifies me. 3 weeks before the BIS announcement was published, it was drafted. Someone in Basel wrote that sentence about Tier 1 reclassification. That document circulated through internal review. Legal teams examined it. Compliance offices signed off. Dozens of people saw it before it became public. And in the financial world, advanced knowledge of regulatory changes is worth more than gold, more than silver. My theory, a central bank or someone with direct access to central bank communications front-ran the BIS announcement. They knew silver was about to become a reserve asset. They knew every central bank in the world would suddenly need to acquire physical metal to meet their new capital requirements. They knew demand was about to explode, so they bought first. 400 million ounces, locked up, controlled by a single unknown entity, and now, as central banks scramble to comply with the new BIS guidelines, they are discovering something that should make your blood run cold. There is no silver left to buy. I need to walk you through the mechanics of what is happening right now, because most people do not understand how this market actually works. The COMEX, the primary exchange for precious metals futures, operates on a fractional reserve system. This is confirmed. It is not a conspiracy theory. It is how the market is designed. For every ounce of physical silver in the vaults, approximately 100 ounces of paper contracts trade hands daily. The system works because most traders never take delivery. They buy futures, sell futures, and settle in cash. The physical metal just sits there, a token amount backing a massive paper edifice. But the system has a fatal flaw. If enough buyers demand delivery, actual physical silver, not paper promises, the entire structure collapses. There is not enough metal to satisfy the contracts. The exchange must either find silver that does not exist or default on its obligations. Guess what is happening right now? As of this morning, standing delivery notices for the December contract totaled 187 million ounces. The registered inventory at COMEX, 28 million ounces. Let me say that again so it sinks in. Buyers are demanding 6 times more silver than physically exists in the vaults. This is confirmed, the numbers are published daily, anyone can see them, and this is not a future problem. This is happening now. The exchanges have 3 options when facing a delivery crisis. Option 1, find more metal. Call every refiner, every mine, every private holder and beg them to deliver silver at any price. Option 2, settle in cash. Pay the contract holders the current market value plus a premium to walk away without taking metal. Option 3, force majeure. Declare an emergency, suspend trading, and change the rules. Here's what I can tell you as of 6 hours ago. COMEX has already contacted at least 4 major refiners requesting emergency delivery of any available silver. My source at one of these refiners told me the conversation lasted 11 minutes. The answer was simple. We have nothing. Every ounce is already spoken for. The metal is not there. This is confirmed through direct source communication. I trust this source with my life. They have never been wrong. Cash settlement is the next option. And there are rumors, unconfirmed, but from credible channels, that the exchange is preparing cash settlement offers at premiums of 40% above spot. 40%. If silver is at $71 and they are offering to settle at $100 per ounce to avoid delivery, what does that tell you about the true value of physical metal? But here's the problem with cash settlement. The unknown buyer, the entity that controls 400 million ounces of paper, is refusing. They do not want cash. They want metal. And there is nothing in the rulebook that can force them to accept a cash substitute. I received a document this morning that I am going to share with you now. I cannot tell you where it came from. I cannot verify its complete authenticity, but it bears letterhead from a major bullion bank, and the details it contains align perfectly with everything my other sources have told me. If this document is real, and I believe it is, we are looking at the beginning of a systemic crisis. The document is an internal memo dated December 19th, 3 days ago. It outlines the bank's silver short position and their delivery obligations for the current contract month. According to this memo, the bank is short, meaning they owe physical delivery on 62 million ounces of silver. 62 million ounces, one bank. Their available inventory, 4.3 million ounces. They are short 58 million ounces with no means to acquire them. The memo discusses several options: emergency procurement from miners, leasing from central bank reserves, approaching the Federal Reserve about temporary liquidity support. And at the bottom of the memo, highlighted in yellow, is a single sentence. If delivery obligations cannot be met by December 27th, recommend immediate consultation with legal counsel regarding force majeure declaration and potential regulatory intervention. December 27th. That is tomorrow. I need you to understand the stakes of what happens in the next 24 hours. If COMEX declares force majeure, if they suspend trading and refuse to honor delivery obligations, it will not just be a silver story. It will be the end of trust in the entire futures market. Every commodity trades on futures. Oil, wheat, copper, natural gas. The entire global economy depends on these contracts being honored. Farmers hedge their crops. Airlines hedge their fuel. Manufacturers hedge their raw materials. If the exchange can simply refuse delivery when the market moves against the big players, what is the point of the contract? What is the point of the hedge? The moment COMEX defaults on silver, every other commodity becomes suspect. Every futures contract in existence becomes a potential lie. Capital will flee. not just from precious metals, from all paper assets, from anything that is not physically held in your possession. This is the scenario that keeps central bankers awake at night. This is the dominoes falling moment that could make 2008 look like a minor correction, and we are possibly less than 24 hours away. But wait, there is something else happening that the mainstream financial media has completely ignored. While the COMEX drama unfolds in New York, something even more significant is occurring 8,000 miles away. Shanghai. The Shanghai Gold Exchange, which also trades silver, is experiencing something unprecedented. As of yesterday, the premium for physical silver on the SGE versus the COMEX price was $18 per ounce. Let me put that in perspective. If silver is trading at $71 in New York, it is trading at $89 in Shanghai for the same metal on the same day, an $18 gap. In a normal market, this would be impossible. Arbitrage traders would buy in New York and sell in Shanghai, pocketing the difference until the prices converged. But they cannot do that if there is no metal to move. The gap exists because the physical silver market has completely disconnected from the paper market. The COMEX price is a fiction, a number that appears on screens but does not reflect what anyone will actually pay for real metal. Shanghai is showing us the truth, and the truth is far higher than $71. I spoke with a dealer in Hong Kong last night. This is a source I have known for 8 years. He moves physical metal for high net worth clients across Asia. His word is his bond. He has never exaggerated, never speculated, never told me anything he could not verify. He told me that in the past 72 hours, his firm has received purchase inquiries totaling over $600 million. $600 million from one dealer in 3 days. The buyers are not retail investors. They are not Reddit traders. They are sovereign wealth funds, family offices managing old European money, industrial conglomerates desperate to secure supply, and he cannot fill a single order. He has called every contact in his network. Refiners in Switzerland, depositories in Singapore, private vaults in Dubai. The answer is the same everywhere. Nothing available. The metal has vanished, not figuratively, literally. The global supply chain for physical silver has completely seized up, and here's the detail that made me stop breathing when he told me. He said 3 of his largest clients, institutions that have been accumulating gold for years, have shifted their entire focus to silver in the past month. When he asked why, one of them gave him a single-word answer: batteries. This is where the story takes a darker turn. I mentioned earlier that someone knew about the BIS reclassification before it was public, that someone built a 400 million ounce position based on inside information, but the BIS announcement is only half the picture. There is a second announcement coming, and if my sources are correct, it will dwarf the reserve asset reclassification in significance. I cannot confirm this. I want to be absolutely clear. What I'm about to tell you is based on 2 independent sources who have been reliable in the past, but who are giving me information I cannot verify through public documents. You should treat this as theory, not fact. But the theory is this. In early January, a major automaker is expected to announce a breakthrough in solid-state battery technology, a battery that solves the fundamental problems that have plagued electric vehicles for a decade: faster charging, longer range, no fire risk, and the critical component, the material that makes it work, is silver. Not trace amounts, not micrograms in the circuitry. We are talking about substantial quantities of silver in every single battery pack. If this announcement happens, it will fundamentally transform silver from a precious metal into a strategic industrial commodity. Demand will not increase by percentages. It will increase by multiples. And the 400 million ounce mystery buyer, they knew about this too. They are not just front-running the BIS announcement, they are front-running the complete restructuring of global silver demand. Let me connect the dots because the picture is becoming clearer. The BIS reclassification ensures that central banks will be competing for silver. Confirmed. The mystery buyer has locked up the equivalent of half a year's global supply. Confirmed through trading data. The COMEX is facing a delivery crisis that may result in default within 24 hours. Confirmed through multiple sources. The physical premium in Asia shows the paper price is meaningless. Confirmed through live market data. Industrial demand for silver and battery technology is about to explode. This is theory, but it is theory based on credible sources with track records. Now add one more piece. The short position. This is the part that will define the next week. The short squeeze that is only beginning to unfold. According to the most recent Commitment of Traders report, this is public data, completely confirmed. The commercial short position in silver futures totals 487 million ounces. 500 million ounces that the banks and trading houses have promised to deliver. Metal they do not have. Metal that does not exist. Metal that was sold short on the assumption that prices would never rise high enough for anyone to demand actual delivery. That assumption just died. With silver at $71, every single short position open below 63 is underwater. Every bank, every hedge fund, every trading desk that bet against silver is hemorrhaging money with each tick higher. Their only escape is to buy back their shorts, to close their positions before the losses become catastrophic. But to buy back a short, you need a seller. Who is selling right now? Nobody. The mystery buyer is holding. The retail stackers are holding. The industrial users who desperately need metal are not selling their inventory. They are trying to add to it. There are no sellers, which means the shorts cannot cover, which means the losses compound with every hour that silver stays elevated, which means desperation is setting in. I received a call at 11 p.m. last night from a source inside a major bank's trading operation. He sounded scared. Not nervous, scared. The kind of fear you hear in someone's voice when they realize they are watching a disaster unfold in slow motion and cannot stop it. He told me that his desk's silver position was down $400 million in unrealized losses. 400 million, one desk, one bank. He told me that senior management had called an emergency meeting, that counterparty risk assessments were being conducted overnight, that there were conversations happening about whether to approach the Federal Reserve. He told me something that I found almost impossible to believe. He said the word bailout was being used in internal discussions. A bailout for short positions in silver. If you do not understand why that is terrifying, let me explain. In 2008, the government bailed out banks because they held toxic mortgage assets. The argument was that their failure would crash the global economy. Now we are potentially facing a scenario where banks need to be bailed out because they bet wrong on a precious metal. But who would pay for such a bailout? Taxpayers? You. Money printed from nothing that dilutes the value of every dollar in your pocket. And the irony? The reason people buy silver in the first place is to protect themselves from exactly this kind of monetary debasement. The banks short silver to suppress the price. The price rises anyway. The banks face catastrophic losses. The government prints money to bail them out. The money printing drives more people to buy silver. The price rises further. It is a doom loop, and we just entered it. Here is something that happened in the last hour that you need to know about. The COMEX has announced an emergency maintenance window. Trading will be suspended for 60 minutes beginning at noon Eastern Time. Routine system updates, according to the announcement. In my 11 years of covering this market, I have never seen a routine maintenance window scheduled on a trading day with this level of volatility. I do not know what this means. I cannot confirm anything. But my instinct tells me that this is the window when decisions get made. When phone calls happen between the exchange and the banks and possibly the Treasury Department, 60 minutes where the public cannot see what is happening, 60 minutes where the rules might change. I am watching this with extreme vigilance. By the time you see this, the maintenance window will have passed. The outcome will be known. But as I record these words, we are in the dark. And the darkness is where manipulation lives. Let me talk about what happens next. Not speculation. Projection based on the mechanics of the situation. If COMEX continues operating normally, if they honor delivery obligations despite lacking the physical metal, they must source silver from somewhere. The only remaining sources are mining companies and private holders. Mining companies sell their production through forward contracts. They cannot simply redirect output to the COMEX. Their silver is already spoken for. Private holders, people like you, have metal. Coins, bars, rounds sitting in safes and depositories. If the shortage becomes acute enough, there will be offers. Dealers will raise their buyback prices. Refiners will advertise premiums for scrap. The question is, what price would make you sell? At $100 would you sell? At $150? At $200? This is not a theoretical question anymore. We may be days away from finding out what the true market clearing price for silver actually is. And I suspect it is far higher than anyone expects. But there is a darker possibility that I need to address. Government intervention. In 1934, Franklin Roosevelt confiscated gold. He made it illegal for American citizens to own monetary gold and forced them to surrender it to the Treasury at a fixed price. Could the same thing happen with silver? I do not think it is likely. The political environment is different. The legal precedents have shifted, and unlike 1934, we live in a globalized world where Americans could simply move their metal offshore, but desperate governments do desperate things. If silver continues its ascent, if it reaches $100, $150, $200, and if the banking system is genuinely threatened by short position losses, I would not rule anything out. This is unknown territory. I am not predicting confiscation. I am telling you it exists as a tail risk that prudent people should consider. The best protection? Diversification, not just in metals, but in jurisdictions. Metal held in multiple countries is harder to seize. Metal held outside the banking system is invisible to authorities. I am not giving financial advice. I am telling you what I would consider if I were in your position. Now let me address the question everyone wants answered. Where does the price go from here? I want to be careful with this. I am not a fortune teller. I cannot predict the future. Anyone who claims certainty in a situation this chaotic is lying to you. But I can share the framework I use to think about price targets. The first reference point is the 1980 high. Silver reached $50 per ounce when the Hunt brothers cornered the market. Adjusted for inflation, that is equivalent to roughly $185 today. We have not reached that level yet. From a purely historical perspective, silver could nearly triple from here and only match its previous inflation-adjusted peak. The second reference point is the gold-silver ratio. Historically, silver has traded at roughly 15 ounces to 1 ounce of gold. Right now, with gold at 2,800 and silver at 71, the ratio is approximately 39 to 1. If the ratio returned to its historical average and gold stayed constant, silver would be $186 per ounce. If gold continued rising while the ratio compressed, the number goes higher. The third reference point is replacement cost. What would it cost to mine an ounce of silver from scratch if every existing mine were depleted? That number depends on energy costs, labor costs, equipment costs, and the grade of remaining deposits. But the most pessimistic geological assessments suggest that marginal production costs could exceed $100 per ounce within a decade. The market may be front-running that reality. I want to share something personal with you. I have been covering precious metals since 2014. In that time, I have seen bull markets fizzle, short squeezes get crushed, and manipulation win again and again. There were moments when I wondered if the thesis was wrong, if the suppression was permanent, if the price would never reflect the underlying fundamentals. Last night, as I watched the ticker cross $70, I felt something I have not felt in years: vindication. Not for me personally. I have no stake in being right beyond my own credibility as an analyst. But vindication for the millions of ordinary people who have been accumulating silver for years, who endured ridicule from friends and family, who watched their holdings stagnate while the stock market soared, who questioned their own judgment every time the price got smashed on a Sunday night. They were right. They were early, but they were right. And the world is about to find out. Let me tell you what I am watching for in the next 48 hours. First, the COMEX response to the delivery crisis. If they announce force majeure or settlement changes, all bets are off. The price could gap up $20 overnight as trust in the exchange evaporates. Second, central bank statements. If any major central bank acknowledges the BIS reclassification publicly, if they announce silver purchases or reserve reallocations, it will confirm that the new paradigm is real. Third, industrial announcements. If the battery technology news breaks ahead of schedule, if Samsung or Toyota or any major manufacturer confirms silver-intensive production plans, industrial buyers will panic. Fourth, the unknown buyer. If we get any hint of who controls the 400 million ounce position, if their identity or motive is revealed, it could clarify whether this is a short-term trade or a long-term accumulation. Any of these developments could accelerate the squeeze. All of them together would create conditions for a genuine price explosion. I need to address the counter-arguments, the reasons why this could all fall apart. Counter-argument 1, the price has gone up too fast and will correct. This is possible. Every parabolic move experiences pullbacks. A drop from 71 to 60 would be a 15% correction. Painful, but not unusual in volatile markets. But here is the difference between a healthy correction and a trend reversal: volume. In a correction, selling volume spikes as weak hands exit. In a trend reversal, buying volume disappears as the thesis breaks. Right now, selling volume is minimal. The pullbacks last hours, not days, and every dip is being bought aggressively. The structure remains bullish. Counter-argument 2, the banks will find a way to suppress the price like they always have. This is the harder question. I do not underestimate the ability of concentrated financial power to distort markets, but the suppression required physical metal. The banks leased silver from central bank reserves. They dumped naked shorts into the market during thin trading hours. They triggered stop losses to create cascading liquidations.